Well, good morning, good afternoon, and good evening, everyone. Thank you for joining our webinar today, hosted by the International Ethics Standards Board for Accountants, IESBA, on its definitions of listed entity and public interest entity exposure draft, more commonly known as the PIED. My name is Jeff Kwan. I am a principal at IESBA and will be the moderator for this webinar. As you are aware, the ED was released in late January with comments due on May 3rd, and we have also recently reduced a supplementary guidance to the ED. Now, to give us an overview of the exposure draft today and all the key aspects, we're very fortunate today to have the PI Task Force Chair, Mike Ashley, as our presenter. Mike has been as an IESBA board member since 2016 and previously was a partner with KPMG in the UK. Before I pass it to Mike, I would just like to give you some very basic house rules, and really there's only just one. You can post your questions anytime during the presentation. There is a question tab that you should see on your dashboard, and we will gather all the questions during the webinars and answer some of these questions towards the end. There will be a Q&A time at the end. So without further ado, let's welcome Mike. Mike, the floor is all yours. Thank you.
Thanks, Jeff. If you want to flip over to the first slide. What we're proposing to do today, and there are quite a lot of slides, but I will rattle through them fairly quickly if you'll forgive me, because I do think the important thing is to spend time on questions and answers at the end. But what we're going to run through is the overarching objective that we have within the ED, some discussion around the approach that the IESBA took to revising the PI definition, the proposed PI categories that we have in the ED, very importantly, the role of local bodies and also the role of firms, and then just picking up on some other matters at the end. So if I turn to the next slide in terms of background, I mean, the drivers for the project was the definition, particularly of listed entities, sufficiently clear and functional. And also there was a concern that the definition, which really was just listed entities and has been adopted around the world to quite an extent with just listed entities, was too narrow for today. Now, when we first introduced the code back in early 2000, we adopted that very narrow definition because other than listed entities, we felt that it needed to be left to be determined which entities should be treated as PIs, largely within the remit of local regulators. There's been some demand, particularly from the international regulatory bodies, that is no longer sufficient, that we need to have a wider definition. At the same time, the SMP community was concerned about independence requirements for smaller entities, and there were queries around what did listed entities mean in terms of the differences between regulated stock exchange, recognized stock exchange, secondary markets, etc. So all of that, if you like, was the background to the project. We appreciated at the outset, if we can flip on to the next one, that we needed strong coordination with the IASB staff. The IASB, both at staff, task force and board levels. And as it shows here, we had that very close cooperation, particularly around the overarching objective, which I am hopeful still that one day the IASB will also embrace, the use of listed entity in its standards, and also what we were proposing around transparency, which we'll come on to later. So I turn now to the overarching objective. There were really a number of reasons for defining this. We can go on to the next slide, sorry. Firstly, I think the task force felt it was important for their own purposes to understand what was the underlying rationale for defining something as a PI. Secondly, and as we'll come on to in a minute, we decided very early on that we were never going to come up with a total global definition that worked everywhere in the world. And therefore, it was important to have whatever we came up with underpinned by an objective that meant other people, when looking on how to apply it in local jurisdictions, would have that in the back of their minds in terms of thinking about what needed to be done in that jurisdiction. And when we thought about a pie, I think it was not, if you like, thinking about it in the context of having differing levels of independence, nor indeed, if we come on to the IESBA, having different standards of audit. There is only one, if you like, you've still got to be independent. There are no different standards of independence. As much as anything else, this is to do with perception and inspiring confidence that independence exists. And when you come on to the audit, that indeed those audits are done to a very high standard. So when we looked at the overarching objective, if we go on to the next slide, we defined it by following a building block approach, if you like. Can we go on to the next slide, please? Sorry. So the first thing we said was there was significant public interest in the financial condition of certain entities. And we'll come on to what we mean by financial condition in a minute. Because of that significant public interest, it was important that there was public confidence in the financial statements of those entities. And in turn, confidence in the audits of those financial statements would enhance the public confidence in those financial statements. And therefore, the overarching objective for these additional requirements is to enhance that confidence, to enhance confidence in the audits, which will in turn enhance confidence in the financial statements. We go on to the next slide. And the focus, as I said, is in the public interest in the financial condition of an entity. We had a lot of debate about the term financial condition. We started off by saying financial statements, but the board determined that actually it was potentially slightly wider than the financial statements themselves. We didn't want to be seen to be putting total emphasis on the financial statements. And therefore we came up with the term financial condition. As I said, as it says here, financial statement, financial performance, financial position were felt to be too narrow from the perspective of public interest. We didn't feel we had to define it because we felt, if you like, it followed common English usage. But we also wanted to make it clear that it was to do with a financial condition and therefore to do, if you like, with something that the auditors do indeed deal with. And the supplementary guidance has a number of examples of things where there may be significant public interest, but actually it's not significant public interest in the financial condition. One example, for example, social media providers. There might be significant public interest in how they manage the collection, use and disposal of their users' data because they contain personal and sensitive information. There may also be obviously interest from the investors in those social media companies in terms of their financial performance. But if those are narrowly held, I think it is harder to say that there would be public interest in the financial condition of a social media company, and therefore that would not necessarily be caught by the PIE definition. If it obviously has a wide range of investors, it's likely to fall under the publicly traded aspect anyway, and therefore that would be caught. But as I say, in the absence of that, there's no reason to feel that just because there is public interest in what it does, there is necessarily public interest in its financial condition. We then thought about, well, how do you measure, or what criteria do you use in assessing the level of public interest? So if we go on to the next section, next slide. So that led us to think about the factors that might lead to that public interest in the financial condition. And one was nature of business activities. There are a number of entities whose business model involves them taking on significant financial obligations to large numbers of the public as part of the entity's primary business. So for example, deposit taking or insurance businesses are the classic ones in that regard. There are, to some extent, not necessarily exactly the same, but largely duplicative with that. There is an element where regulatory supervision provides confidence that financial obligations will be met. It is primarily, but isn't necessarily restricted to financial market players. Size is also clearly a factor. Something may be either so small it would never be of public interest, or so big that actually it will always be of public interest, even if it doesn't meet some of the other criteria. And Certainly there has been a tendency in some jurisdictions to start thinking about the role of large private companies within the economic well-being of a country, because their demise can impact a large number of other companies and or customers and or employees. So size, again, is a factor. Also importance to the sector. If something is hard to replace if it fails from financial purposes, it is more likely to have a higher level of public interest. So, for example, things like public utility entities, financial market infrastructure entities. If they are privately funded and privately supported and their financial failure causes damage to the ecosystem and they're hard to replace, then that would indicate public interest in their financial condition. The number and nature of the stakeholders, institutional investors versus retail investors, may also be a factor. None of these are determinant. I would say that certainly isn't. And then systemic impact, entities that are, if they did fail, they have ramifications not just in their own sector, but across the ecosystem. A lot of those obviously are caught by the definition of financial entities and captured by the proposed list of PIEs. We then, having thought through those were the factors, what enables us to best achieve that overarching objective? So we can go on to the next slide. As I said, very early on, we decided that there was no way we could come up with a global definition that was going to be of universal application. It would either be struck at a level which meant that it brought in a lot of things which, quite frankly, should never be recognized as PIEs, or it ran the risk of leaving things out, very much, if you like, as the way the narrow definition does today. And we thought really there were only two ways we could go. One was we could stick with that very narrow definition and just leave it up to local regulators to add in, and a number of them obviously have done around the world, but not all. We felt that probably would not meet the expectations of the global regulatory community, who wanted, if you like, a bit more of a push to make local regulators adopt a wider definition more universally. And therefore, we thought if we have a broad approach, we are going to have, in order not to be carving in things which should not be regarded as PIEs, we would have to have a lot of flexibility in terms of allowing local regulators to scope entities out, in effect. And therefore, we agreed that both, not only should they be allowed to add entities, but they should be allowed to exclude. And as an example of the difficulties that we thought would be there, you've just got to look at the EU approach to PIEs, where yes, they have managed to, if you like, include both banks and insurance companies within their definition of PIE, but interestingly, by reference very much to the legislation, which happens to be at a European level, that allows them to narrow that definition to those entities which clearly meet the regulatory definition. But at the same time, they've also allowed, basically at a country by country level, exclusions, particularly, for example, credit unions, which are largely carved out of the PIE definition, but they're carved out by reference to what the country regards as appropriate to carve out, not what the EU has decided as an EU level to carve out. And that's just an example of why we think that the broad approach can work, but it does need the flexibility of allowing individual regulators to tighten that definition, A, to make it clear exactly what is included, but also the flexibility to make it clear what is excluded. So if we go on to the next bit, having decided that there was a broad approach, we then said there is a role for the code, there is a role for local bodies, and there is a role for firms. And the role for the code is very much to set the groundwork for what we expect the local bodies to do, both by defining the overarching objective, by articulating the criteria we expect to be applied, and by articulating what the types of entity we feel as a starting point would be included. And very much in terms of the list of entities that expanded list of PI categories, which we'll come on to, I would say it was very much the 80-20 rule. We looked around the world at what other people had done, and we included those things which we felt on balance were likely to be included, and we left out those things which on balance we felt were likely to be excluded by local regulators. If we can go on to the next slide. So what we've done with the proposals is we've expanded our broad PI definition to 6 categories. As I said here, we've included those which are likely to be adopted by most jurisdictions and therefore suited for a global list, largely because of the nature of their functions. And we've excluded those categories which would probably only be included by local bodies because they're very large. And as much as anything else, that was because we, again, at a global level, we felt it almost impossible to come up with a definition of what was very large. That will very much be dictated by the context in which that is applied. So if we go on to the categories and go on to the next slide, this led us to a slight redefinition of listed entity, which we've defined as public traded entity, to encourage people to think about secondary markets and other facilitated trading mechanisms, not just a listing being the be all and end all. We've defined it as an entity, one of whose main functions is to take deposits from the public, which is the best definition we could come up with for bank, because again, bank can cover a multitude of sins if you're not careful. We came up with an entity, one of whose main functions is to provide insurance to the public. And we used one of whose main functions specifically because obviously most banks will do things other than just take deposits from the public. And quite a lot of insurance groups do things other than just provide insurance. We also decided that we would pick up post-employment benefits, retirement benefit funds. Again, some countries around the globe have done that. We deliberately phrased it as an entity whose function is to provide, so that we were not capturing employees who happen to have, as part of their employment package, a fund, but rather the fund itself. So we're trying to capture those entities which have long-term obligations to significant numbers of employees. We wanted to pick up things like investment trusts, unit trusts, etc. So again, an entity whose function is to act as a collective investment vehicle. We had redeemable financial instruments because if they were closed-end investment trusts, we felt that they would be captured by the publicly traded entity definition and therefore didn't need to be captured again. And obviously we had the sweep all at the end, which is an entity specified as such by law or regulation. We did put in, though, to meet the objective, because we didn't want people to think that just because, and PI can be used for other purposes just from accounting, we didn't want there to be confusion that just because something was defined as, quote, a PI in a local jurisdiction, if it was clearly not with a purpose for being of public interest because of its financial condition, that wouldn't necessarily bring it into this definition. If we can go on to the next piece. Public traded entities, as I said, we replaced listed entity. It is a broader term. Financial instruments was meant to be broadly applied, so it can be warrants, options, loans. We deliberately used publicly traded instead of publicly listed because there are occasions when things get listed but are never traded. So, for example, I'm conscious that for tax reasons, intragroup bond issuances can be listed, but they're never traded outside of the group, and that it was felt we didn't need to be capturing. We wanted, as I say, to pick up facilitated public trading mechanisms. So again, from our discussion with some of the firms, they indicated that a number of them were treating, for example, pink sheets in the US, which is a form of facilitated trading, but is not actually a listing, were actually being treated as PIs because they are regulated by the SEC. We looked at whether or not we could pick up entities which were in the process of being listed on a local exchange, but the way things go in for listings around the globe does vary. There can be prolonged timescales involved. Some of it may just be intention, and therefore we felt it difficult to come up with clear criteria, if you like, which would mean it ought to be being captured. So we felt it was best in this context to leave it as one of the factors for the firm's considerations, because they will be familiar with the context of the client and how, for example, feasible or otherwise the idea of listing is, and how close they are to the process. We did have a discussion near the end of finalising the exposure draft as to whether things like initial coin offerings or other innovative ways would be captured either by this definition or whether it needed something separate. And again, the board has asked for specific views on that. We'd be interested as to what comes back on it. If I go on to the next category. So as I say, entities here, we use one of whose main functions versus whose function in D and E. And we're already using banks, insurance companies and pension funds in the extant code as examples for firm consideration, so that if you like, it's like no brainer to extend the broader definition to that category. And as it says there, and I mentioned the EU example earlier, in some jurisdictions, certain types of banks or insurance companies like credit unions or some smaller mutuals get excluded from their by definitions, and we would expect that to continue. Move on to the next one. So as I said, with D, we are trying to capture the funds themselves. We're not trying to capture employers that just have contractual obligations to provide post-employment benefits. And in category E, we are trying to capture those fund vehicles where investors basically realize their investments by selling them back to the entity. We go back onto the last one, which is F, and that is really just an extension of the extant by definition. As I said earlier, it's effectively, we're trying to ensure that it isn't capturing things which are defined as pies for reasons other than public interest in their financial condition. So that's the categories we've come up with. We did also consider a number of others. We can go on to the next slide. And you'll see in the exposure draft and the explanatory material, we looked at things like charities, custodians, financial market infrastructures, large private companies, private equity funds, public utilities, public sector entities, stock and commodity exchanges, and other potentially systemically significant entities. All of these we felt may fall as categories to be considered by a local regulator, but it was not clear to us that they would, as a generality, be considered by every regulator to such an extent it was appropriate to try and include them on some basis in a global code. So, for example, if we go on to a few of these, if we go on to the next slide, we looked at custodians. There were a number of stakeholders who questioned if custodians should be included as a PI category. They take very different forms in terms of the custodian. It goes from those who actually have discretionary management to underlying safe custody arrangements. There's quite a variation in the types of entity that are involved, the size of them, how significant they are, what the local jurisdiction has in terms of local regulation around the separation of those custody assets from the assets of the custodian itself. And in a number of cases, the financial statement auditor does not really have an ambit over the role of the custody side of it. They do in some cases, not in all. So on balance, we felt that it was not the financial statements per se that would be of public interest. It would be the arrangements around their holding of those safe custody assets. So again, for those reasons, we felt it was not appropriate at a global level to include them as a PI category. We go on to the next one. Similarly with public utilities, a big variation. I'm very conscious, for example, in the UK, that the generation of electricity is split from the distribution of that electricity, is split from the end delivery of that electricity to the customer. So there are a number of companies which are involved in the end user sale, if I can put it like that. I have been through 3 in the last 7 years personally, because they tend to be comparatively small companies, think they've got an ability to sell cheaply in the market, sell too cheaply and go bust, at which point they just get their service rolled on to the next one very easily. So I've never looked at their financial condition. I have no interest in their financial condition. Their investors are no doubt a bit unhappy, who tend to be private equity type investors. But actually, I have no interest whatsoever as a member of the public in their financial condition, because the arrangements are such that their demise is of no consequence. So again, it was felt that because the nature of the market, the way it's constructed, varies so significantly country by country, it would be difficult to come up with a definition that worked at a global level. And we go on to the next one, either financial market infrastructure or stock and commodity exchanges. So you've got things like payment system providers. A number of the exchanges are now listed entities in their own right. A number are mutuals, and therefore not necessarily even producing accounts, let alone having them audited, let alone being regarded as a pie. With financial market infrastructures, the payment system in the UK is effectively underwritten by the large banks. And I was prompted by this project to look at their financial statements to discover they were showing a very healthy deficit, at which point I lost interest, because it was quite clear that their financial statements didn't mean anything. It was basically relying on bank support. So at that point, as I say, I think we concluded also that because of the differing structures that you can have around this, it would be very difficult to have something at a global level. And the last one, as I say, with the other ones, if you want more discussion in terms of the categories you looked at as you want to the next slide, please look at the discussion that we had in the supplementary guidance that we released this month. So we go quickly on to the role of local bodies, which is key to the success of this. And we go on to the next slide. Quite frankly, obviously, if nobody adopts this code within their local jurisdiction, we will have failed. Equally, if people adopt this ED in their local jurisdiction without refining it, we will also have failed. It is not suitable to be picked up word for word and put into either local regulation, legislation, or indeed PIO codes. It needs to be refined. That is very important. So we've got a list of factors that we expect to be taken into account. We've given a starter for 10 as to the categories. We are proposing a longer transition period, and if people feel that we need an even longer transition period, by all means make those comments in the response. And we are looking to develop our outreach activities. We've already developed some guidance material, and we're looking to socialize the approach as much as possible. We did do a questionnaire to about 50 professional accountancy organizations across Asia, Middle East, Africa, and Central and South America through the IFAC network. It was to seek their input on the role and capacity of local bodies to refine the definition, as we were hoping they would. We got about just over half, 50% response, which indicated a strong indication. I'm sorry, we didn't get 50% that didn't indicate a strong indication. We got 50% responses, and those indicated a strong indication that it should be achievable. Indeed, a number of countries, I was pleased to note, had already gone further than the IESBA extant code in defining what a public interest entity was. If we go on to the sorts of questions that obviously a local body might ask when refining it, it is clearly key to work out what is a publicly traded entity. Should they exclude some of the smaller ones? I know some jurisdictions believe that there should be a size criteria attaching to this. Whether the local law and regulation already effectively describes what constitutes public traded and what the trading platforms are, what particular second-tier markets or other trading mechanisms exist. Similarly, what is a public deposit, a deposit taker? What should be defined as a bank? And again, there's likely to be a local banking law that will start as a foundation. Are there some types of institutions that should be excluded, such as credit unions, mutuals? Should state-owned banks be included or excluded? And certainly this is where I would encourage all participants who have an interest in this to be working with their local bodies to make sure that this works properly. So one of the unspoken roles for the firms in this, if you like, is to ensure that the local bodies actually do a good job in the first place. The explicit roles for the firms are two. If we can go on to the next slide. The first is a determination as to whether there should be additional entities to be included as PIs, and the second one is around transparency. So if we deal with the first of those, we can go on to the next slide. This is already a requirement in the Australian and South African codes, where it seems to have worked reasonably well. It is, of course, included as application material in the extant code. We're looking to only say firms can add entities. We have been questioned as to why, if a local body has done its job properly, should there be any need for the firms to add. And I suppose here, and based on the experience in Australia and South Africa, it's quite clear that no regulation or legislation can seek to capture everything, because it will not be seeking to capture things inappropriately, and therefore it will draw lines. And sometimes those lines, for particular circumstances, may not be drawn in quite the right place. So there may well be some entities which are not captured by local legislation, and we think it is appropriate and should not be unduly burdensome to require the firms to think about, and require them to think about, not just lead them to consider whether or not to think about, but to require them to think about whether they should be adding others in. Clearly, we are thinking that in terms of the criteria that that firms should apply here, we're not looking for them to add in something which a local regulator has specifically determined should be carved out. That would clearly be bonkers. Therefore, where that is, if you like, something to be taken into account. We do think as to whether something is going to be defined in local regulations as a PI in the near future, and an example there would be an entity which is in the process of gaining a listing. That would be a factor that the firm should take into account. Similarly, precedent is something that we would expect the firm to be taken into account. We do think that if the entity itself, and you've got to remember this whole underlying objective here is to inspire confidence in the financial statements, the entity itself believes that it wants to inspire that confidence for whatever reason and makes a request to the auditor to be treated as a PI, we think that is something that the firm should consider. We don't think they should be obliged to, because the last one is also, I think, important in terms of the entity's corporate governance arrangements. A lot of the requirements under the IESBA code applicable to PIs, and indeed under the IASB code as applicable to listed entities, is all about communication with those charged with governance. Implicitly, that means there's got to be a sensible corporate governance arrangement which has got those charged with governance who can respond appropriately to those communications. So we do think that is a factor that the firms should take into account. If we go on to the other requirement, again, there was a plea for consistency globally. That is hard to achieve for once you don't have a global definition, you're going to have some element of inconsistency. Therefore, I think the board felt it was very important that actually we should increase transparency around when something is or is not a PI. So there is no confusion in anyone's mind when they look at a set of accounts as to whether the auditors have treated that entity as a PI and applied the differing requirements, both certainly in the IESBA standard and depending on which way the IAASB goes in due course, IAASB as well. We did suggest that might be done within the audit report, and the IESBA are going to consider that as part of their further analysis as they do their auditor reporting post-implementation review, and will also take into account comments in response to this ED when thinking about that. But the key to me is not necessarily where it is, but the fact that it is transparent. And transparency, I think, helps mitigate a number of potential problems. One is, to say, global consistency, because it will be clear in any jurisdiction which entities have and have not been treated as a PI. The second thing, which people have expressed some concern about, is there might be some form of, quotes, opinion shopping if some auditors would treat an entity as a PI and others wouldn't. Again, if there's transparency around that, I think that helps mitigate that risk considerably, because if something which has been treated by a PI as a PI by one auditor is then not treated by the PI by the successor, inevitably there will be some questions asked. The very last bit I just wanted to touch on, if we can come on to the next slide, in terms of other matters, was related entity. And there is one place where the listed entity is used within the code to produce, if you like, a different answer. So for an audit, if an audit client is a listed entity, then that definition of audit client includes the 5 related entity categories: upstream, downstream, and sister. For others, indeed including other PIs, it is downstream only, so client has direct or indirect control. And if we are effectively getting rid of the term listed entity, we obviously have to do something about that. And we did consider whether we should extend that to that listed entity audit client definition to all PIs. And I think it's hard to say there are any strong philosophical reasons why you wouldn't do that. And when we explored why that had occurred in the first place, and that it had been defined just in terms of listed entity, the difficulties that were apparent seemed to be caused more by the nature of the group corporate structure that surrounded the entity than the nature of the entity itself. So in other words, private equity complexes, sovereign wealth funds, it would be difficult to apply some of the requirements on an upstream basis in that context. So we felt that there was a need to properly consider the impact on Part 4A, and as an interim action, we have proposed replacing listed entity with our new term publicly traded entity, which we felt would narrow any potential adverse impacts of the extension. And therefore, if you go on to the next slide. And so that is where we've ended up, and we will, I think, review in due course, potentially as a separate IESBA workstream, how we deal with the term audit client for other PI entities, as I say, probably taking more account of the corporate structure around those than anything else. Okay, if we go on to the next one, we did, as part of this project, say that we would look at Part 4B. We concluded we would not make any revisions to Part 4B because if there was greater public interest, it would be as much to do with the nature of the engagement in assurance engagements as it would be to the nature of the entity, and it wasn't really within our scope to start defining what we might mean by a public interest assurance engagement. So we have left that as is. If we look at the discussions we've had with the IAASB, go on to the next one. We have discussed with them whether we should have a common overarching objective for additional requirements. And I say I am hopeful that at some stage they may pick that up. They were generally supportive of the idea. They want to look at their standards to see whether the requirements that currently only apply to listed entities might be more broadly applied to other PI categories. And that has indeed happened in a number of countries, frankly, already. Where it tends to be a view taken for both audit and independent standard requirements that you have a definition of PI, and they're looking therefore to consider whether that's how they might align their terms with ours. So it's a project that they will have underway, taking into account the responses from this ED. And as I said before, they will look at the the transparency disclosure requirement as to whether it would be appropriate to put that in the audit report. Go on to the next one. Just in terms of effective, as I say, what we're looking to try and do is agree the final standard by the end of this year, whilst the NAS and the fees effective dates have been fixed as December 2022. We would be looking to have a longer effective date for this project, partly obviously because it is finishing later, but also more importantly to allow local bodies to refine that definition, obviously bearing in mind the consequences it will have given the requirements in both NAS and fees, which have been extended in terms of what requirements there are applicable to PIEs. It also gives us time to develop some more guidance material and to work with local bodies, either directly or through IFAC, to make sure this happens. So the last few slides, obviously comments due May the 3rd. We have, as I say, issued some guidance material this month as a staff publication. I'd encourage you to look at that in terms of thinking about your response. And really over to questions.
Thank you, Mike, for the presentation. If we can have the next slide. We do have some questions that have come in. So, Mike, I hope you're ready. I guess we might start with something a little bit more general. What about a large private hospital network that has significant impact? Would that not have sufficient public interest in the financial condition, and therefore would that entity then be categorized as a PIE?
But potentially, yes. I think if the financial failure of that hospital caused significant detriment, then I think certainly it might be regarded as a PIE. I think it's that would be, if you like, caught within the sort of factors that we've listed. We haven't included hospitals as a specific definition within the categories, simply because, again, the funding and the structure of hospital networks within differing countries varies considerably. I mean, as you'll know, in the UK, it is largely state funded. So the demise of a private hospital in the UK, and there are some, is not likely to cause significant detriment to the public.
Mm-hmm. Thanks, Mike. Next question, we might just go back up to the overarching objective. We have one question about what if entities have, I guess, met all the factors in paragraph 400.8, but doesn't come under one of the specific categories. Would those entities be automatically classified as PIE?
I don't think automatically, because the factors are factors to be considered either by local bodies in terms of their definitions, or indeed by firms in terms of what they might also include as PIEs. So clearly, if for whatever reason an entity seemed to tick all of those factors but had not been included by a local body as a PIE, one would expect the firms to do so.
Thanks, Mike. Then we have a few questions more about the PIE categories and the proposed definition. First question is, what about a company that issues bonds that are tradable over the counter? Would you consider then under the proposal as a publicly traded entity?
I think, yeah, over the counter is another term that has varying definitions and meanings attached to it. I think that if there is a facilitated trading mechanism that allows members of the public, and I don't just mean necessarily individuals, but also others, but large public trading, if I can put it like that, to be facilitated between members of the public without going back to the firm every time, then I think it certainly would be classed as a pie, yes.
Thanks, Mike. Another question about the pie definition. It's on the impact of the change and perhaps a little bit broader. And a specific example is, what about an insurance service provider that is also 100% subsidiary of a listed company? How would we classify that insurance service provider?
We've not really, at this stage, I think, thought deeply about the impact of having multiple pies in the same group. It exists today, clearly, and I think that that is not inappropriate. Clearly, some of what you have to be careful of, and I was very clear when we were discussing NAS, for example, is that if you do have multiple pies in the same group, where you are requiring communication with those charged with governance, what you don't want to do is to end up with a system which is unduly duplicative, which is why we've allowed a fair amount of flexibility in terms of the process that is agreed within those constructs as to, if you like, which body of those charged with governance deal with what, and very much left it to them to agree amongst themselves, if you like, and with their auditors as to what is the appropriate process to put in place. I'm very conscious that what we don't want to do is end up with duplicative things. I do think, however, you could end up with pies at a subsidiary level where the parent is not a pie because of this definition. And I do think you could end up with multiple pies in the same group, i.e. where you've got a pie as a subsidiary and a pie as a parent. I don't think there's anything wrong in that. I think that could be made to work with the various requirements that we have in the code. I don't know if that answers the question, but...
Yep. Thanks, Mike. Another question is, hang on, I might have lost my spot there. Yep, sorry. Another question is, can local bodies exclude one or more of the categories of pie from the IESBA code? For example, in the EU definition of pies in the Audit Directive, it obviously doesn't include post-retirement benefits or collective investments undertakings, even though obviously they could be included in the member states' own definition of pie. So can local bodies exclude one or more categories of pie?
I don't think we can rule that out because, in effect, because we've given freedom to local bodies to make that determination, then, as I say, we can't exclude that possibility. And again, as has been articulated, a number of member states in the EU have included pension schemes. Generally, pension schemes above a certain size. So again, you've got this problem of size criteria, which I think is difficult to apply universally. I think it would be something we would encourage local bodies to think about, which is why we put it in there on balance. And therefore, depending upon the nature of the pension provisions that they have in various jurisdictions, whether or not there are entities which should be caught within that. That's not to say that those types of entity will exist in all jurisdictions. There may well be pension retirements, which mean arrangements, which means that generally speaking, you don't have large funds which are established, which pay out over prolonged periods of time post-retirement. Quite a number of pension arrangements for companies in various jurisdictions allow for, if you like, a sort of termination type payment. That probably wouldn't have the sorts of pension schemes that we would be thinking about here in terms of capturing them as pies.
Thanks, Mike. Perhaps I might switch gear to talk a little bit about the role of firms. What would be the impact of an entity categorized as pie? Under the proposal, would there be any new reporting requirements for a firm?
I'm not sure what you mean by reporting requirement. Obviously, we would expect, as part of the transparency disclosure we've got here, for them to be reporting they had indeed treated as a pie. but otherwise we would be expecting them to comply with the various provisions within the IESBA code applicable to PIEs.
Yep.
So
Thanks, Mike.
to the extent there are reporting requirements within those criteria, and there are, for example, around fees, then yes, we would expect them to comply with that.
Okay, thank you. Another question similar on also reporting. In the case of, say, audit firm A would classify a client as a PI, and then the auditor changed to audit firm B, and B decide that this client should not be classified as a PI, would audit firm B also have to make this decision public or declare its reasons for doing so?
I think, I mean, it would be public in the sense that it would move from being treated as a PI to being treated as a non-PI. So if you like, that information would be available to the public. Whether or not the firm felt obliged to provide a rationale for that, and or the client itself wanted that rationale explained, I think would be up to them then. As I say, you might expect questions to be asked depending upon the circumstances as to whether it was obvious why one thing had stopped being treated. I mean, something, for example, delists, you can well imagine it goes from being a PI to being a non-PI. That's unlikely to require much explanation.
Yeah. Thanks, Mike. Another question on SMEs. Has any consideration been given to the relationship of the PI definition with respect to SMEs? Of course, small and medium-sized entities, or what the IESBA is working on, LCEs rather, less complex entities. And the point being that any definition should not be unduly burdensome for a vast majority of entities out there being audited.
I mean, again, I think that comes down to the flexibility we're giving to local bodies, which, if anything, we're giving slightly more flexibility to, because, as I indicated earlier, there is nothing to stop a local legislator or regulator, or indeed PAO, looking at the particular construct of their local stock exchange and saying, well, actually, entities of such a small size do not need to be included, whether they would have been in the past as listed. That already happens to some extent in the secondary market space. So again, my experience, as you'll tell, is very UK based, but I mean, in effect, the FRC in the UK has taken the view that AIM listed needs to be captured, but captured at a particular size level. And sorry, AIM is our secondary market.
Mm-hmm. Thanks, Mark. And you've mentioned FRC and AIM there. We actually have a question about your part of the world, Mike. Will IESBA be contributing or responding to the PI discussions in the UK as part of the UK audit reform?
That's probably one more for Stavros than it is for me. I have to say that I looked at the proposals, obviously, because I do have an interest in them, and I did not feel they were a million miles away from what we were trying to achieve. I felt actually they might usefully think about some of the objectives and the factors that we've got in their consideration, but otherwise I didn't have a big problem with the general thrust of the proposals, I have to say.
Thanks, Mike. We're going back to some of the PI definition. This question is, what if the shares of an entity are traded in,
My apologies.
in a market?
I'm just going to kill that.
Okay. All right. Let's start again. If the shares of an entity are traded in a market where only the authorized organizations, such as a licensed financial institution, can do the trading, would that entity fall within the IESBA's definition of publicly traded entity?
Do
you want me to repeat that? Do you want me to repeat that?
The very start of that.
If the shares of an entity are traded in a market where only the authorized organizations can do the trading, would that entity fall within the definition of publicly traded entity?
I mean, it's getting very fact and circumstance dictated. I think that would be something that a local body would look at the nature of those markets. My sense is probably not if it was very restricted. But again, you know, if there's a wide body of those authorized institutions, that could be regarded as effectively public trading, particularly if they are doing it in effect on behalf of underlying clients.
Yep.
So,
Thanks,
you know,
Mike.
again, I think that would be very fact and circumstance dictated.
Yeah. And obviously, you know, the local bodies would come into play here, and I guess as part of their adoption process and working with all the stakeholders and with firms to look at what should be included and how they refine the code's definition. Next question we have is, Mike, you've touched on a little bit about some of the categories that the IESBA had considered, but decided that they're perhaps not suitable for the global code. One of them is FMIs, and payment institutions. You mentioned that perhaps their financial condition is not, you know, perhaps the public interest, the level of public interest might not be as high. The question is, what if in another country the financial condition of the entity is linked to its operational continuity, and they're not supported by a bank or other institutions? In that case, can we then scoop them in as in the local code as a pie?
Yeah, I mean, I think it hits a number of the criteria that we set out. All we haven't done is, if you like, have them as a category.
Right.
And the category, as I say, I regard very much as a very strong steer as to, you should certainly be thinking about all of these, but you don't necessarily need to think this is an exclusive list. It is only example. It's almost, it's not quite example. It's beyond examples, but it's designed to say this is very much your starting point. But then go back and look at the criteria. And if in your jurisdiction there are other things which tick these boxes, why are they not being included?
Thanks. And probably we've got time maybe for one or two more questions. Next question I've got is, the term traded may not be as clearly defined as listed in many countries. So in fact, it's more or less a suggestions, and see whether you have a response, Mike, is whether to have listed entity or listed as a rebuttable assumption and include because they are in substance traded, and whether we should include that as a pie, as a rebuttable presumption or assumption.
I think the definition and the criteria we've set out are clear enough as to what the intent is. As I said, we deliberately didn't put listed because actually there are, and again, it's interesting that again in the UK, they've now excluded these. You can have instruments which are listed for reasons other than actually being entered into public trading. So intergroup bond arrangements, which may be listed and never traded. There's no reason to capture the entity which issues the bond further down the group as a pie.
Thanks, Mike. We've got a few more questions, but we've run out of time here. So we might finish it here. Diana, if I can get you to go to the next slide. I just want to again recap what we're going to do in the next stages. The comments will be due in May, 3rd of May, and we'll be looking at doing the task force will be looking at doing full analysis of the comments received in September and its first read, and then we'll be doing the second read in December, and with anticipated approval of the final text in December this year. We want to especially thank you everyone who has joined our webinar today and have listened in. I really appreciate your interest in our project, and we believe it's very important work and in public interest. And certainly we would love to have as many comments as possible. And we would also like to particularly thank Mike for his time and for his presentation and walking us through the different key aspects of the exposures draft. So we will finish here. If you, we will upload today's webinar on our webpage shortly, hopefully in the next week or so. And if you are interested, there is another webinar coming up Monday next week. So you are more than welcome to join. Although if you are in my part of the world in Australia, it could be a little early. But thank you again, everyone, and have a great morning, afternoon, or evening, wherever you may be. Have a great rest of the day.
Thanks, Jeff.